Thanks, Deanne. Let me add my welcome and thanks to our sponsors and welcome panel. I'll just open with a brief couple of comments to set the scene around the industry. It's a pleasure to be here representing IMAP. Our role is to represent managed accounts, be the authoritative voice and the go-to place for partnering with managed account providers, suppliers and others that are designing, building and distributing and advising on managed accounts. So it's a pleasure to have such a strong panel, two very experienced industry participants from two of the more relevant sections of the managed account market, in particular platform. We've got Peter Panigiris joining us from Dash on the far right. Peter's a sales executive at Dash, an ex-aeronautical engineer, aerospace engineer, launched satellites out of Colombia in the past and has migrated to Australia and is one of the hallmarks of Dash and has been integral to their strong early growth. And Andrew Stewart, who's a principal at Mercer and responsible for their manager selection, portfolio construction. So please welcome the panel and thank you. And I'll start with just a couple of these introductory comments. The first thing is that it's a really big year for managed accounts and particular MDAs. And what's driving that is growth. If we look back 10 years to 2016, the managed account industry was circa 39 billion, and as at 30 June 2025 on IMAP data, we were sitting around 255 billion in assets. Our census results, Toby, for June 20, the December period, are due to come out next week.
The first issue of Managed Account Newswire.
Great. Okay. So hold your horses on that, but you know, circa the growth is continuing at CAGR 25% per annum plus on average. And Generation Development Group, GDG, came out with some numbers stating that their view is that managed accounts will reach about 470 billion by 2030. So, you know, $500 billion, here we come. And some experts have said that, you know, upwards of 60% of industry flows will come through managed account structures in Australia within 5 years. So this is a fast-growing sector. It's building scale, and you can see the majority of the growth is actually in the SMA. That's the large blue line on the far right, reaching near 170 billion as at 30 June 25. But MDAs are also growing, and they represent around about 25% of the industry. And last week, Financial Newswire announced that 3 in 5 advisors in Australia are now advising on managed accounts. So we've got high growth, but with that comes high attention. And the big year is, in fact, being our engagement at IMAP with ASIC around 2 of their key programs. One is they've got a dedicated surveillance program in the managed account space, live now. So if you're an MDA provider or a platform offering and distributing SMA or MDA product, there's a high probability you've received contact from ASIC as part of their surveillance program. It's an enforcement and misconduct project. So they're looking for the appropriate best interest and legislative requirements being met when managed accounts are designed, distributed and advised on. Gents, I don't know if you want to comment on that at some point if it comes up, but it's a forthright project that's live today. And the other big thing that's happening in managed accounts is on October this year, the MDA relief instrument 2016/968 actually expires. It has a 10-year sunset. And at IMAP, we've got a regulatory group that's been engaging the regulator to help them understand the practical implementation of MDAs in Australia. So how are they actually operating? which can be their short suit because they're not practically offering and running MDA or managed account businesses. They're smart people, and they're looking to roll that legislation and make it as efficient as possible, streamlining it. And IMAP has made a submission there and essentially helping them produce sensible regulatory outcomes so that the MDA market is sustained in Australia. So we're behind that at IMAP, working hard with the regulator. It's part of the work that Toby and I and the team have been doing. All right, so I've introduced the panel. We've talked about the growth. I want to turn to our experts. Each of them will do an 8 to 10 minute, who they are, their role in managed accounts in Australia, and the theme being, you know, the future of managed accounts or the latest developments in managed accounts. So the first of those will be Peter. Peter's just going to talk from microphone. And over to you, Peter, for the best on Dash. Thank you.
Perfect. Thanks. Thanks, Steve, and thanks for the intro. Can I get the clicker as well?
Oh, sure.
Thank you. Okay. Merging shape of managed accounts. So before I explain who Dash is and explain how managed accounts are changing in Australia, I want to go back a little bit and just provide a little bit of context on tech and platform in the industry. So apologies if I butcher this. When the first platform, Generation 1 platform, was released, I was still in diapers. So I try to talk to what I know and what I've been told. But Generation 1 platform was the master trust. When you had managed funds back then, you had to sign a prospectus, email a check to the managed fund provider. You'd get something coming back saying how many units you got, and then you'd report on that for a client. That's when something like Asgard and those Gen 1 platforms came into being, and that was an industry revelation. It was great for advisors, helped them out. In the late 1990s, then we started to wrap all these managed funds into a custodian structure. And then early 2000s, we brought listed equities into that custodial structure. And that started to give a bit more efficiency to advisors and to their practices. Then you got the mid-2000s, we had non-unitised managed funds, which got rebranded to SMAs. That came out, and that was a big, big change for advisors. And what you saw in Steve's graph before, I think it's like 2 in every $3 is going into SMAs right now. So it's huge, and it's providing a lot of efficiencies to advisors. And nothing has really changed since then. But now in the early 2020s, we're starting to see a Generation 5 platform come into being. And that's giving advisors access to non-custodial assets and alternatives. So you're seeing Hub do their non-custodial solution. You've got NetWealth doing their MAPS, I believe it's called, where they're allowing advisors to invest in non-custodial assets as well. We at Dash have been doing this for about 6 years now. So having these non-custodial assets, making it easy for you to manage, feel like a platform, work like a platform, smell like a platform, but not a platform. So that's what we're seeing now with these Generation 5 platforms. And the reason it's all moving this way is traditional portfolios and traditional advisors, they rely heavily on doing manual trades, individual client execution. I remember when I was paraplanning, we had our paper model portfolio, and the advisor would make an update to that portfolio, and I'd have to go through 250 different portfolios and make the same update on every single one. We were using MLC Navigator and CFS First Wrap, I think, can't even remember. And I was going one by one into every single one, and that was an absolute nightmare. Had to get ROAs written for all of them, had to make sure every client signed that ROA. That was a nightmare, that sucked. It took me nearly 2 weeks. So that brings compliance issues, because you're making a change 2 weeks ago to the portfolio. Some clients weren't even invested until 2 weeks later, 3 weeks later, 4 weeks later, depending on when they sign. So that makes it hard for businesses to manage that. The other thing we're also seeing is advisors are starting to want access to different types of investments. Not more products, not more ETFs, more managed funds, more equities. They're wanting different types to get alpha, more alpha, and just improve, make make them a bit more unique out in the market. So you're seeing private markets come into play, private credit, private funds, international equities, multi-currency sort of investing. We're seeing digital and hybrid advice come in. And we're seeing a lot of this because we've got a private non-custodial offering at Dash. So we're seeing a lot of this start to come. And that's where a lot of our flows are actually going, into these non-custodial areas. So what does this have to do with managed accounts? Well, the big thing is your traditional managed account, or if I separate it, you've got your SMAs and you've got your MDAs. Your SMAs are products, okay? So they have to sit in that custodial layer. They have to sit with managed funds, listed equities, all of that which you can put in a custody. You can't put a lot of these private market, private equity, private credit offerings into a custodian. So you need a solution that's going to allow for something different. And that's where MDAs come into it, because that's a service, not a product. So MDAs enable advisors and their business to centralise the portfolio decisions, similar to what an SMA would do. They give you immediate execution, so straight into market. Can keep your investment outcomes consistent across your client base. And like I said before, it reduces operational risk. Okay, you're not waiting 2 weeks, 3 weeks, 4 weeks to implement advice because a client is on holiday and can't be bothered accepting the ROA on DocuSign or something like that. You might not even use DocuSign. But yeah, it reduces all this operational and compliance risk that you have. It even reduces your paraplanner going through 200 portfolios and not making... I'm not going to lie and say I'd never made a wrong investment. I did a couple of times, but it reduces that sort of risk on the business by having something that goes straight to market. The other thing that MDAs allow is it allows us platform providers to give you access to more sophisticated investment strategies as well, not just the same managed funds, ETFs, equities, all of that sort of stuff. It gives you access to multi-asset and global exposures as well, and alternative and private market access. So this can in turn make your portfolio management a little bit more dynamic. It can give you a little bit more rigor in how you manage those portfolios, and actually make it give you a little bit more dexterity in how you manage it on a client by client basis. Again, because it's not a product, you can customize it per client and have little nuances there. So as the slide says, it effectively moves advisors from the more traditional transaction-based implementation approach to a professionally governed portfolio management tool for you and your business. And that's effectively where we see the future. The future isn't more managed funds, more active funds, more dynamic. It's not more ETFs. It's not more equities. It's giving access to a wider range of investments, giving you operational efficiencies and allowing you to manage that with good tech. And that's powered all by MDAs and powered by service offering.
Excellent, Peter. Thank you.
Thank you.
All right. Thanks, Andrew, for your patience. And over to Mercer now. So Mercer, one of the leading portfolio management consulting businesses in Australia, looking at the engine room of portfolios now, and an introduction from you, Andrew. Thank you.
Thanks, Stephen. So, yeah, Andrew Stewart, Principal at Mercer, Head of Manager Selection. Mercer's a large company. It's based out of the US, large insurance conglomerate, but we've been working with our managed account or financial advisory clients now for a number of years. We've grown in excess of $10 billion. We're certainly well in depth within the advisor market and wealth management market, and it's really a shift for us in terms of overall growth within the broader business. So today we'll just walk you through some of the themes that we are seeing within managed accounts. As Steve did mention, we are seeing pretty significant growth within the broader universe of managed accounts. But that provides, I guess, some challenges and some risks and certainly some themes with regards to not only how we operate, but how we manage the client relationship, how we manage the relationship with, ASIC and enforce governance principles. I was just talking to Chris Reynolds, who we heard from this morning out the back, around client customization and scale. we're growing and we're seeing a number of different advisors coming onto our menus and our platforms. But if we have 200 and 300 different portfolios, how do we manage the individual manager selection there? How do we approach that from a governance perspective? We want to create customised solutions for our clients, but at the same time, we want to achieve that at scale. We want to achieve that by enforcing good governance principles. So it's certainly a factor that a lot of consultants are considering these days, given the increased growth there. Regulatory compliance, you would have seen in the news, especially from an investment menu perspective, ASIC's cracking down. There's been a number of instances over the last 18 months that have kind of enforced their hand a little bit. But we are seeing investment menus change, becoming a little bit more consolidated, managers being removed from the investment menus of a variety of platforms. Also from a client perspective, I guess, changes to minimum sizes and portfolios or number of portfolios. Platforms are becoming a lot more, or they're increasing their scrutiny here. It's becoming a challenge for us. We welcome it. Certainly we don't want to become a cowboy industry where there's a lot of conflicts of interest and things like that. But we are seeing a lot more scrutiny around governance with regards to how we operate and how we deal with our clients. Fee pressure is always something that is emerging right now. Certainly there's clients that want to have more of an alternatives allocation within their portfolios or more of an opaque asset class exposure, less conducive to fee pressures. But certainly there's an emerging side of the advisor market that are looking for cheaper alternatives out there. They're very granular in terms of how they look at fees. So it's always a challenge for us in terms of working with both the platform and certainly some of the managers out there in terms of relieving some of that fee pressure that comes through. But what I'll focus on today at a very high level, given that I've got about 8 minutes and hopefully I don't miss too many things, this is the actual, some of the themes that we are seeing. Private markets is something that I'll focus on today. We are looking to broaden out the availability of private markets and a private market solution for our clients. But there's various steps involved. We don't want to rush out something to the market that might be not in our clients' best interests, that might present some illiquidity challenges. So it's certainly an area that we want to dip our toes into, offer it to our clients, but we want to make sure that we're mindful of the considerations around what private markets may bring to investment portfolios. Why private markets? I won't go into this in too much detail. Look, if every time I bring out private markets or private credit in one of these presentations, you do get a lot of advisors who are very anti-private markets, and I do get questions around, why it's always going to present illiquidity challenges. That's okay. Certainly with our clients, if they don't want those illiquidity issues, we'll just present a public market solution for them. But in our view, private markets do provide diversification, return enhancement, certainly on the private equity side of things. The illiquidity premium from private equity over the last 20 years has been around 2 to 4% relative to public equities. So you are getting that kicker from the illiquidity premium, the alpha surrounding that. Inflation protection, certainly if you're having an allocation to, unlisted real assets, whether it's unlisted infrastructure, real estate, you're getting that inflation protection through, capped overall investment guidelines and just real economy exposure. So that's certainly targeting more of that US middle market private equity approach or private debt approach. You're really broadening the opportunity set there, and it's really blending in within your existing public markets exposure. So look, overall, we think private markets is a complementary solution set for clients. We think it definitely brings about a certain level of diversification and return enhancement for our clients. But we're conscious about managing that relationship and the end advisor managing that end relationship with their clients as well. So there has been a number of different challenges for consultants, not just Mercer, in terms of bringing about private market solutions. There's been a number of consultants who have brought solution sets to market. There are a number of consultants working on different solution sets, whether that's a tailored solution set or a more generic white label solution set. But there certainly are some challenges. Illiquidity is one of them. We're certainly stepping into an asset class where 7, 8, 9, 10-year lockups are pretty permanent across the asset class base. There isn't that liquidity that you are getting from public markets. How we've looked to, solve this for now, and it's a evolving kind of space is around evergreen structures. I believe there's about 50 in the market now within Australia, providing liquidity through cash sleeves or general liquidity sleeves through whether it's treasuries. They do present not a daily solution set to liquidity, but are providing that kind of quarterly redemption process or monthly application, quarterly redemption process that certainly alleviates issues around liquidity that you may see from more private market solutions. Another area of the illiquidity challenge that we are looking to solve, or the solution set there, is dedicated private market sleeves. So that's essentially a sleeve that operates in conjunction with clients' public market portfolios. So we are talking to a number of different platforms right now. This is potentially the solution set there. For example, you have an 85% allocation to a public markets SMA, you have a 15% allocation to a private markets SMA. If there are illiquidity challenges within your private markets SMA, you can obviously seek liquidity from your public markets allocation, whether that's cash, equities or bonds. So that's definitely a solution set that may be rolled out for a number of different bespoke and tailored clients. Customised SMAs or customised manager solutions. Mercer has a relationship with Panigiris around the private debt solution, and we actually have a unit trust that we only offer to our SMA clients. So in that relationship or in that structure of the investment, we can control the cash levels, we can control the flows in and out of the product. It's only there for our clients. So it's a little bit more manageable from that side of things in terms of the daily liquidity needs of our clients. And finally, there tech and process enhancements, whether it's AMP North, whether it's potentially CFS, Hub, they are looking to really expand out their private markets offering, investing in research, investing in tech in order to actually facilitate private market solutions. In my view, it's not there just yet. Certainly, it's a working piece. We are also seeing standalone private market platforms start coming into the market but are potentially offering secondary trading, have their own built-out treasury platform capabilities. So we are seeing a lot of innovation from platforms, and hopefully that will lead to a very optimal outcome for our clients who are actually looking to invest in private markets. High fees. Unfortunately, there's not too much getting away from this. Look, private markets do come, or private market managers do come with higher sets of fees than public markets. I'm sure I'm not shocking anyone there in terms of that reveal. I'll probably also say that it's also quite hard to negotiate with a lot of private market managers, whether it's private equity or private debt. They do have a little bit of a stronghold within the market. So we might be looking at a 50 basis point rebate for a public equities manager. That's really not the case within private markets. So it can be a little bit of a struggle in terms of not only the baseline fee level, but trying to negotiate fees with certain private market managers. Look, how we're approaching it is using our scale, to be honest. Mercer is a global research house which has trillions of dollars of assets under consultation. We can certainly leverage some of those relationships. So we are having those initial conversations, working it through, trying to get the best fee outcomes for our clients. But fees are certainly something that stands out when you are looking to implement a private markets portfolio. It's certainly a challenge, and a number of different consultants now are working through that. Finally, their evergreen solutions. I've put that in there. It probably needs a little bit of an asterisk. Evergreens can have a layer of retail fees applied, so they're not necessarily cheaper, but certainly, working with those managers and working with trying to renegotiate the 50 plus that are here on the Australian market is what we're looking to do at Mercer. So once you've solved for illiquidity, once you've solved for higher fees or working towards that, we really just got to be conscious about accessing the best funds out there and the funds that we have the highest conviction in. Yes, there's 50 private market vehicles here on an evergreen structure. Are they the best managers within the broader universe? Are we just selecting from what's available, trying to push out a product, trying to create a solution that's immediately available to our clients right now? And at Mercer, we've kind of pulled the brakes a little bit, made sure that we are doing the right due diligence. again, I'm not trying to just flog Mercer here, but having that global presence allows us to really compare the evergreen structures that we are looking at within the Australian unit trust, or the Australian environment, against global peers. So when our research looks at a particular private equity fund, it's not just comparable against what's available here, it's comparable against the hundreds and thousands that are potentially available across the globe. So that's where we work in tandem with our global research team. They're certainly just not looking to give out an investment grade strategy rating because it's accessible here, and that will push our products and help us out. It's quite stringent, and that's really how we're trying to solve for not only bringing about liquid, well-positioned managers from a fee perspective, but also trying to bring about the best conviction strategies to our client portfolios.
So just if I may interject there, the theme I'm hearing here is sophistication, and that the advice has moved from a transaction-based industry to a service-based profession, and managed accounts are evolving in that theme. So the SMA was more of a product-style solution that fit with the old selector portfolio from an APL list, and the MDA is more suited to the more sophisticated client requirements. Peter, would that be a fair comment? And perhaps answer that in the context of the major growth is still in the SMA space. Why is that?
Yeah, like I said, that you're correct, Steve. Like I said earlier, the big reason for that is SMAs are a product. It's from an advice point of view, you're doing exactly what you've been doing before. You're going onto your APL, you're selecting an SMA, having a chat with the SMA provider like you would before. Use us instead of this, do this. It's from a process point of view, nothing really changes for you guys. But coming into an MDA structure, that's a service. It's not a product. So there's significant operational changes that you need to make in your business to allow for an MDA structure. It does require more governance. It does require a little bit more work, but it does give you access to a lot more sophistication than what an SMA would provide you. So that's a choice you can make with the business. We're seeing a lot of businesses at Dash, because we lease or rent our MDA to businesses, so you don't need one on your AFSL. We're seeing a lot of businesses start to take this up real quick because it gives them more access to sophistication. And we're also there to, Shannon and I, we act as consultants to train you guys on what you need and how we can help implement this service change.
So, Peter, it's fair to say the advisors are getting over that sort of feeling of complexity associated with the MDA versus an SMA?
Yeah, I think it's that feeling of complexity and the bad rap MDA's got, but once you get over that feeling of complexity, it's actually not that much harder.
And are they better at incorporating alternatives? I mean, that's the key thing coming out of here is sophistication and alternatives, private market assets.
Definitely better.
Right.
Yeah.
Non-custodial or custodial?
Non-custodial.
Yeah.
Yeah.
Okay.
A lot more alternatives are non-custodial.
Okay. And Andrew, Mercer construct portfolios for both wholesale and retail clients. Is there a difference between the two in the way you build a portfolio?
There is, and it really comes down to illiquidity. So you obviously, I'm sure everyone expects this, wholesale investors can tolerate a lot more illiquidity, so we are seeing a lot more alternatives used within those models. We are seeing a real emergence of wholesale offerings and wholesale demand within Mercer. So look, we have conviction in certain managers in the public sphere that we look to translate over into the wholesale investment offerings as well. But surely, I guess, having that illiquidity premium, having that access to alternatives is certainly something we're seeing within the wholesale build out for our clients.
Excellent. And given current geopolitical circumstances, are you managing portfolios differently in this environment today, doing anything unique?
Geopolitical events are pretty hard to try to predict, especially these days. And I guess over the last month, a lot of the returns that we saw, a lot of the losses came in the first week. So you'd have to act pretty quickly to try and predict that and trying to manage that. We're trying to predict these events before they actually occur. And that's really about having a well-diversified portfolio, having protection in that portfolio, whether it's through equities or, I guess, alternatives as well. So you're well kind of insulated from some of these risks that we are seeing, whether it's what's happened in the last month, in the last, I guess, 12 months ago around the trade kind of kick-off. So it's really about planning for these events. We haven't done too much turnover this month. But I guess some of the questions we are getting from advisors, which is nice, during the course of this month is when are we actually going back in the market? It's not like, let's move to cash right now, let's freak out. It's around, staying controlled, staying well diversified, trying to access opportunities right now, and it's actually quite difficult because Trump's tweets can really shift the market from here to there on a day-to-day basis. So it's just being well prepared and having a plan in place, but certainly not trying to turn over the portfolio when we see these types of months and these types of events.
And Peter, given that Dash is outsourcing its MDA licence, the risk sits with Dash for those that are running money under the MDA licence. So how are you feeling about current geopolitical circumstances and just managing risk within your model?
Yeah, so the risk does sit with us because it is our MDA it is our AFSL on the line, but we take instruction from advisors. A lot of the compliance risk is stripped out of this from our point of view because we do some deep due diligence on the advisors and the AFSL before we rent out our licence. So we need to make sure you have proper governance in place. It's not just a one-man advisor in an investment committee saying, oh, Pete, should we make this change? Yes, Peter, we should make this change. It's not just that. We need to make sure that there's some asset consultants or someone in there. But we're not too fast either because we've gone down the path of building tech to allow you to manage portfolios at scale. So if you do want to get out of a certain asset sleeve or get out of a certain investment, you can do that with 5 clicks of the button and get 1,000 clients out of that, literally with 5 clicks of the button, straight into market, done. So we've built that to be scalable. And while we do have some compliance overlay over this, we do a lot of this up front.
Yep. And ASIC has recently produced a consultation paper on underperforming assets. It's mostly focused on super options. Is this something you've got your eye on? Question for both of you, in fact, around your governance process and due diligence?
Yeah, our trustees, equity trustees, who's getting slaughtered in the market right now. So they're, from a retail super point of view, they've started to cut the APL, and we're a bit hamstrung by that, but that's okay. It's probably a good thing. On our wealth side, it's full non-custodial. So if advisors want to invest in that, they can. It's on them. If they want to use our MDA, we just need to make sure we're comfortable with it.
Yep.
Yeah, it's something at Mercer that we're acutely aware of because of the MST or our super trust. They've been dealing with performance tests for a number of years now. So it's always something that we thought was going to impact the industry, certainly from a generic or a white label build out. So we are starting to monitor the portfolios against a number of different investment objectives and benchmarks. Certainly we're aware of licensees and platforms cracking down. So we've been well prepared for it. I guess knew it was coming to a certain degree, but it's just around flexing, I guess, the internal processes and teams within Mercer to try and facilitate that and work with that with our clients.
Excellent. All right. Well, look, we might open up in our final couple of minutes questions from the floor. Has anyone got a question for either of our panellists? Toby, I know you do.
Yeah, look, I guess the question to Andrew about access to private market investments and their incorporation. I mean, how do you model the impact of illiquidity? I mean, do you deal with it as a thing to one side, or do you actually model illiquidity into expected portfolio outcomes?
Yeah, so We model it in conjunction with the portfolio. Just like a number of other consultants, we have our own stress testing. It's modelled on an asset class level, so we'll look at it under both the normal market conditions and a stress market conditions. And that information is provided not only to the client, but to the platform and other external parties. So it's something that we update on a quarterly basis. We're certainly aware of going through challenging times and market stress. So it's something that's ongoing. It's not only managed at an asset class level, but it's also managed at that total portfolio level as well. So something we're equipped to do, something that a number of consultants are also across. So we've just got to be conscious of that and make sure that we kind of communicate that to our clients and communicate it to the other external parties as well.
And I mean, one of the other questions, particularly in private credit, given the turmoil that's going on there, is whether we're in a situation such as we were in during COVID with the valuation of airports, where the implied volatility, the volatility you're seeing in the instruments isn't really the true volatility that might exist in the underlying assets. Does Mercer have a view in the private credit area about what the real volatility of this asset class is?
Yeah, look, we try to look through it. It can be difficult. Even evergreen vehicles that we're talking before can be valued on a quarterly basis, but that's really up to the manager's discretion. So is that the actual real valuation of the underlying asset? Look, we do predict for the worst outcomes with regards to individual asset valuations and the volatility around that. We look at not only private equity in general, for example, but VC private equity. What's the worst outcome from a volatility aspect from that perspective? So it's about constant engagement with the manager, making sure that they're actually fulfilling the requirements around valuation principles. It's also about, again, going back to that stress testing element. What we're seeing right now with the BCDs hasn't really impacted us. It's certainly something to be wary of. I'm a little bit more critical of private credit in general than some of my peers, but look, it's really just about knowing the risks before you actually invest in some of these asset classes, knowing the valuation risks, knowing the illiquidity risks, making sure that you have a well-diversified portfolio, and you're also investing in some managers that not only have great balance sheets, but great investment teams and are used to seeing these types of environments. We don't want to invest in smaller boutique managers, but you've got to have the infrastructure behind you to really deal with these periods of stress. So that's where we lean. We're a little bit more conservative from that perspective, but it is that constant engagement with the manager and making sure you're stress testing the portfolio in an accurate way.
Excellent, Andrew. Thank you. Well, a wise man once said, there are only two places in the industry where value is genuinely added. One, where trusted advice is delivered, and two, where alpha is created. And so hopefully today we gave you two great examples of alpha creation, platform alpha in the case of Peter, and investment alpha in the case of Andrew. Please thank our panellists.